Thanks to Delupa for sponsoring this season of Compounders. Delupa scales the velocity of an investment team's idea generation by allowing analysts to spend less time locating and manually inputting meaningful disclosures into Excel. As someone who spends a lot of time updating models with data that some of the other major platforms, such as Bloomberg and Capital IQ, don't capture, I have seen firsthand how much time Delupa can save professional investors. Specifically, Delupa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Their data sheets also include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Delupa's Excel plugin can also update existing models for the latest quarter in just a single click. More bulge bracket banks and top-tier investment managers are trusting Delupa for assistance in initiating coverage, building and maintaining industry dashboards, and keeping models up to date. Please visit www.delupa.com/compounders to learn more about how Delupa can help increase your team's speed to differentiated insight. Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Tyler Hart, the Senior Portfolio Manager at Seagate Capital Management. After spending about 9 years at Artisan Partners, Tyler decided to go out on his own and start a firm in 2018. Tyler is an unabashed value investor who even wrote a book called Value Investing, A Disciplined Framework. In this insightful conversation, we discussed the founding story of Seagate Capital and why Tyler felt like he was ready to be an entrepreneur, how Tyler finds companies that both have sustainable competitive advantages and trade at reasonable valuations, why he decided to write a book about value investing, what he learned about himself as an investor during a very difficult environment in 2020, and the guardrails he has put in place to help prevent his strategy from losing money. And without any further ado, here's my interview with Seagate Capital's Tyler Hart. After spending 9 years at Artisan, you decided to start Pelican Bay, now called Seagate. I would love to hear the founding story and about what made you feel like you were ready to be your own boss.
I think if you ever become an investor and you're managing money, you want to have your own shop, right? And that was something I always wanted to do from day one. And I knew that I'd be at Artisan for at least 10 years. In fact, I told one of my partners when I signed up that you have my commitment for 10 years. I'd love to do something at some point, but I'm going to work for you for 10 years. And then, I was lucky and fortunate to work with, the three PMs there, George Sertle, Scott Satterwhite, Jim Kiefer, like all amazing investors. And what ultimately ended up happening is in, year 5, Scott Satterwhite retired. And I'd argue he's one of the best small cap value investors on the planet, up there with Chuck Royce and George Wiper. And then you've got, and then George retired, and I was sitting there and I was 2 or 3 years early, and I just felt like it was time to go and do it now. The markets have been, going well for a while. Value was out of favor. So I figured, hey, maybe we're bottoming on the value trade. So let's go start a value fund. And I was, spending Christmas in our vacation house in Naples, Florida, and I just didn't want to go back to Atlanta, which is where I worked at Artisan, and figured, hey, I've stopped growing there. 2 of my 3 mentors have left. Let's just go do it. And so, I think looking at that in retrospect, if there's anyone listening to this that wants to do this, I think there's no good time. But I would also say, don't go it alone. I went alone, and that was probably a mistake, which is why I ended up ultimately, selling the company and partnering with a bigger RIA that's local to Naples, called Moran. And, if you think about it, I didn't have that salesperson with me. I didn't have a lot of infrastructure. So when I'm putting good numbers up and like the pension funds call, so I get a call from, a big state pension fund, and they're, hey, great numbers. Tell me about your process. Okay. Tell me a little bit about your firm. And you're like, well, how many employees do you have? Well, it's just me. Well, where's your office? Well, I'm working out of my house. That's just not something that any, pension fund wants to hear, or Mercer or anybody else. So ultimately by joining partners and starting a new institutional arm at Moran, which is a local RIA that's gotten scale and has $4 billion under assets and has everything I needed. That just made a lot more sense versus going and spending $500,000 and doing it myself. And, taking to build that infrastructure. It was already here and they're great people. I was, meeting with them frequently to discuss stocks, and I was talking to them about sub-advising at their shop anyway. So instead of becoming a sub-advisor, they gave me an offer that I couldn't refuse and had all the assets I needed. So it really accelerated the time frame to grow the business to where it is today.
And then as you think about solving for that question, that problem, which is, you need an institution behind you to be able to attract those institutional investors. How have you thought about, building a team internally? Are you just leveraging Moran's assets? Like how is it working now versus, when you were on your own?
The nice thing is I'm not the compliance director anymore, right? So when the SEC comes, I'm not dealing with that. I'm not worried about IT issues anymore. I'm really just focused on getting to train an analyst right now. So I'm training an analyst from scratch. And I'm really excited about that. And it's something we were going there anyway. It's just, I was able to do it quicker because I was here. And I'm just really excited about that. So I think it's just more resources. It's more focusing on investing. And I've been able to spend way more time reading and listening to way more calls than I have in the past, because you're just not doing the minutia of handling the clients and handling the day-to-day tasks of being a business owner. It's quite different than just being a value investor. I came from Artisan, and that's where one of the strengths at that company was. You just invested. You just focused on investing. You just focused on research. They gave you all the tools, and that's kind of where I am again, right? So my day-to-day is not dealing with clients, not dealing with anything else. I'm just focused on investing, focused on finding great stocks, and listening to a lot of conference calls.
So in your presentation, you highlight that you're looking for businesses with sustainable competitive advantages that are also trading at a large discount to intrinsic value. In my experience, such companies are often pretty fully valued. What kind of circumstances need to exist for you to find companies that fit both criteria?
Interestingly, I think the easy answer is patience. Because like you say, you have to be able to sit on your hands and wait for a lot of these to come your way. And then when the moment comes, whether, a great example would be in 2020 in March, we rotated a lot of the portfolio because I could buy a lot of these companies at massive discounts, which I haven't been able to see. Like companies I never thought I'd buy as a value investor, Amazon, Moody's, Thermo Fisher, CoStar, just great companies that would have always been incredibly expensive. But in the reality of the matter is, a lot of times you find these good companies and you're watching them and waiting, and then something happens, right? For example, like we bought Generac in the beginning of the year, and that's a company I've admired for a long time, but until they stubbed their toes and until they came off the back of the COVID benefits that they saw, like I never got that opportunity. And then as all the growth people flushed it, valuation came down, it gave us that opportunity to go get it. Similarly, in March, you saw Google. We haven't had a chance to own Google before, and Google came down to look to us to be about 15 times our normal earnings estimate, and we pulled the trigger. We think that's probably about a 25% discount to the low end of fair value when we do an intrinsic value of Google. So, it does happen, but you need things like you need some event for people to get nervous. Whether it's in Google's case, it was, hey, AI is going to wipe out Google search. That seemed like jumping the gun to us. We just think it's different. AI is meeting different needs, right? So when you're searching for Google, a lot of times you're looking for that product. When you're asking AI something, you're not looking for the product. You're looking for help, crafting some kind of content. And it just seems different to us. And we just didn't think it was as big a threat. Then you also have to look under the hood and go, where are the best researchers for AI in the world? And I'm willing to bet that at least 20 out of 100 of them are sitting at Google. And so to think that they can't catch that or understand that, or the fact that Google itself is already its own little AI machine when you're typing a query in, it just didn't seem correct to us. So, it can happen. And then on those really high quality companies like Google, you're not going to wait for a 40 or 50% discount because you might never see it. You're going to go quicker. Now, let's just say there's a company like Generac where there's still some problems on it. You're going to want a deeper discount to that. Or, for example, we bought Expedia recently too, and you wanted a deeper discount when you're going to go after those. But if you have a real compounder a high quality company that can grow, like a Republic Services, a Google, used to be Apple. You'd look at those things and you're going to pay a smaller discount to get them. But even Republic Services, when we bought that, it was trading, and it was just super cheap. And it was just down because of COVID and didn't make sense to us. So we take those opportunities when we can find them. But generally, what ultimately happens is it means we have less turnover. Similar, we run a concentrated portfolio, so we don't have to turn over a lot. But when it does happen, a lot of times you'll see it in spurts. So if you look at our two most active trading periods where we, sold maybe two or three transactions in a quarter, it was March of 2020, and it was just recently March of this year. So generally something's happening, which is giving us the opportunity to make all those changes.
In that response, you mentioned concentration, and that's a topic I've thought a lot about recently. Talk a little bit about how concentrated your strategy is, and how you, as you were moving on from Artisan, how you decided on that level as the one that suits you.
It's a really good question. To be comfortable with it, a part of that was embedded when I started investing, right? So you start reading Buffett and Munger and everything, and you'll notice that they talk about being concentrated quite a bit. Buffett has gone up to 75% in a single position. Munger tells you you're basically an idiot if you don't concentrate. And then, when I was at Wharton, I was studying it. And one of the things that when we took the best track records over a 30-year period, a few things stood out. Those folks concentrated more than the average typical mutual fund, holding anywhere from, 15 to 25 names. You also saw they weren't in New York, which was kind of interesting to me. Only about 30% of them were in New York, despite the fact that, 80% of our industry resides there. Little things like that. They're mostly value investors. I guess, you had Kaufman and some others that weren't, but, mostly value investors. So those things kind of stood out to me. And then when you look at the research, and even just this week, UBS put out a piece. So UBS quantitative research said, hey, guess what? Once you get to 24 names, you're on the median about 10% more volatility than the market, and it doesn't really shrink after that. So, the numbers were there. And then my experience at Artisan, to your point, also helped that. So we had a large cap value fund there. We ran typically around 35 names, and the top 10 or 12 names would be a big chunk of the portfolio. And you could see that drove the returns. Those names drove the returns. The other ones didn't. Like the 1% and 2% positions, even if we got that right or we had a buyout, it really didn't do a whole lot to the portfolio. And I know a lot of people view risk as volatility, which is why they don't want to do this. I think that's a mistake, right? So risk is just one measure, or volatility rather, is just one measure of risk. There's other things like balance sheet, valuation. Those things matter. What's your downside? And we think that about risk. We think about concentration risk. And like even in that UBS report that ran last week, one of the things I thought was interesting is they randomly selected stocks. So they didn't give any concentration to a sector, even a thought. So there could have been samples where you had, 15 out of the 20 were tech names, right? So you just don't know. They were running it randomly. I think also you have to just make sure that the concentrations you have in the portfolio, you're not sitting there owning all the same risk. And in fact, in 2020, in the Q1 of 2020, that actually bit us in the behind, right? So we had a really big drawdown in Q1 2020. It's really the only time we had a big drawdown with the fund. And what happened there was, it turns out when you look across the portfolio, I thought we were diversified, but apparently we had a really strong correlation with shutting the world down. So we had a lot of chemical companies. We had a lot of transportation companies. We had a lot, we had Royal Caribbean in there. We even had a life insurance company, Prudential, which everyone, oh my God, you life insurance, everyone's going to die. So what we found was we had 17 to 20 names in the portfolio at the time were really impacted by COVID. We have looked at this about 6 months ago. We went and looked, and if we didn't sell anything, we just maintained the portfolio, we still would have come out on top and done well over time as those all bounced back. However, we did take advantage of the opportunity and rocket it a little bit quicker out of the gate and bought some higher quality companies that we didn't own before. But that was one where I learned a lesson too. Like we had, for example, we were really bullish on energy in 2019, coming out of 2019. We noticed that the world had been undersupplied for 2 years. It really wasn't part of the narrative out there. And we were approaching a level of oil demand at about 101 million barrels a day, which was equivalent to what we thought global production capacity was. So we expected, prices to accelerate. And then obviously when you shut the world down, that's not going to happen. Everyone knows oil went negative, famously in April 2020. So, one of the things from that is now that we still really like oil, we don't have 4 names, we have 2 names. In fact, we just recently, in our portfolio, we shifted out of a refiner and added another E&P company. So before we had one E&P, one refiner. The refining margins have just gotten really, really fat. They're currently around $30 a barrel. And it just doesn't seem like that can be sustainable going forward. It could be, and this could be a whole new golden era of refining, kind of like in the mid 2000s. It just seems unlikely to us. And not only that, but if we expect oil prices to increase rapidly, refining margins can actually come down. And in fact, refiners underperform when oil's ripping, and they actually do really well when it's coming down. So it actually acts as a counterbalance. And in this case, we think it's going to go up, right? We look around the United States, we're currently undersupplied by about 2 million barrels a day. Global demand appears to be about 103 million barrels a day, according to some reports we saw back in July. We still don't think the world can produce more than 101 million barrels a day full out. So that's with Iran full out. Saudi, if you actually look at the production data, has not come down as much as they've talked about. So we look at those, and we're like really bullish on oil. We're starting to see oil move. The narrative seems to be shifting. When you look at the ownership reports and you look at the commitment of traders reports, it doesn't seem like people are all bullish on oil yet, and it's starting to move. And it's the only thing working right now. If you look at the markets the last month, I think, since the end of July, when the markets kind of peaked in this most recent high, oil has done really, really well. And the stock market isn't. So, we wanted to switch and add extra E&P exposure. We had already owned Diamondback Energy, which is in my mind, one of the best operators in the Permian. Great management team, great acreage, has done capital allocation super well. We recently added Pioneer to the portfolio as well, to kind of round that out. That stock hasn't performed as well in the last year, given that they have a lot of the same correlations as the other Permian players. So we ended up going there and selling our Phillips 66 in exchange for it, because we didn't want to take too much risk in what concentration in one sector.
This season of Compounders is sponsored by Delupa. Delupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Delupa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit delupa.com/compounders. And so when you say you're really bullish on a position, like, is that a 5%, 2.5%, 7.5%? Like, I mean, it sounds like you have 20 stocks. Is it equal weighted at 5%? How should we think about concentration?
When we start coming into a position, if we're like, okay, this is really attractive, we like this, it's better than we have, the discount is pretty wide, but there's still some issue that has to be resolved. We might come in at a 4% position, 3.5% positions. We open it up. There's only one instance in the last 3 years where we really said, oh my gosh, this is the most attractive thing I might have seen in the last decade. Go. And that was Builders First Source. And we opened it up at a 6.5% position. We came strong. We usually do not do that. And then back to the concentration question, we're very active in trimming the position as it grows. So for, Builders just happened, by luck to go straight up. We bought it around $60. It started going up. It's currently, I think it's 128 today. It peaked at 150 a while ago. But while it was going up, it got to a 9.5% position, and the stock was around $88, $89. And you have to ask yourself, would I buy this stock today at a 9% weight in the portfolio at this price? It was still on the low, what we thought the low half of fair value was, because we think about things in ranges, intrinsic value and range. And it wasn't to the middle yet, but it was just below the middle. And the answer was no. You would not sit there today and create a new position at 9%. So we trimmed it down to 7.5 rather. Once again, it kept going up, got back up to 9%. We trimmed it back down to 6. And then recently, when it got to 150, when it was closer to the high end of our range, we decided okay, let's take it down a little bit more. I don't want to sell it yet because it's a compounder and it's not well ahead of that estimate. I think the hardest part about being an investor isn't buying a stock, it's selling it. And it's so many value investors sell the stock way too early. And I'm guilty of this. I sold Apple like $100 ago thinking it was fully valued. So it happens. And I think one of the things that has changed in the last 2, 3 years, being the portfolio manager, is that I'm more willing to hold a compounder if it gets to the top end of fair value versus saying, okay, stock is, say Builders FirstSource and say, okay, it's worth somewhere between, $80 and $150, and then we're reevaluating that. So as they buy back shares and as they prove that their business is more durable than I thought from a margin, it's time to go lift that up potentially, right? So they might grow into a higher valuation in the next 6 months. And I'm going to be really glad that I just took it down to 4.5, because once you sell it to zero, it is really hard to bring it back. It's one of these mental hurdles that's super difficult. So, and we also make a lot of money trimming and adding. So we've trimmed, we trimmed it. The last trim was at 150. Let's just say it comes back to, all the way down to 120. Like, we're going to bring that right back to 5%, right? And a lot of alpha can be created because you already know the company well. You're following it day by day. You see every single move and you're like, okay, we're at the top end of our range. Let's trim it. There is a very good chance, markets are, weighing machines at the end of the day. Let's just say it comes back down to the lower end of fair value. We'll take it right back up to like a 5.5% weight. We do that. And then it goes back up and we'll trim it. So that does happen in the portfolio. It's another way we think about risk mitigation. We're just not going to let something run to a 12% weight in the portfolio. The biggest thing in the portfolio today is Capri Holdings, and that's only because they're being bought out. And I'm looking for a replacement for it. And effectively, the ARB is still pretty wide. So it's got a $57 takeout price. It's currently about $52, $53. So I'm willing to sit on that. It looks like extra cash, which isn't bad too with what's going on in the markets these days. So we're looking for another name. We have some ready to go, but it's just, do I want to wait for that ARB to close and get some better tax benefits for my clients, which is what we're effectively doing.
So it's interesting. You talk about compounders, you talk about owning Google, but then you also talk about owning energy, which I don't think many people think are like, businesses that are, secularly getting more valuable, and so growth and value are oftentimes unhelpful labels. But I'm interested in how you describe your strategy to new and existing investors, because it seems pretty eclectic in given what you're willing to own.
Yeah, I want to have different things going on in the portfolio at any given time. Like, we want things that are working, for example. And I learned that, Leon Cooperman talked about that one day, and it was like a light bulb going off. You're like, you want things that are working, and those are the compounders. And you at the end of the day, after doing this for 5 or 6 years, if you just sat there and you had all compounders, you'd probably do pretty well. I want to own those, but at the same time, you can create a lot of alpha by going into cyclical, and I call those time arbitrage plays. So when you look at a cyclical industry, if they have a good balance sheet, which energy right now, companies have amazing balance sheets. So they're trading for, some of these, I think Diamondback the other day did all the math again. At $75 oil, was trading for a 9% free cash flow yield. At 85, it's trading for 13% free cash flow yield, 14% free cash flow yield. So it doesn't seem really risky to me when I'm looking at it that way, because they don't have the balance sheets that they had going into 2018. They really cleaned things up. But in my mind, I want some companies that are okay. These are more cyclical companies, but they have good balance sheets, and the market does not like them right now. And I want that to be part of our portfolio, because I know that, hey, if this thing can really go to our estimate of intrinsic value using normalized earnings, it's worth 50, 60, 100% more. And if I can make 100% over it and I can wait 3-4 years for that to happen, that's a really nice return. The key to what you want to do is, and I've seen this before, is where your whole portfolio is these time arbitrage plays. And then the market goes up and you're like, oh, and they're all realizing, and you're flipping the new names. And the problem is all of a sudden you look down and, you want your garden to have actually, Scott Satterwhite, what I worked with, has a great analogy. He called it the garden. He's like, hey, I want a third of my portfolio to be blooming, a third to be kind of coming along, maybe like struggling a little bit, and then a third to be brand new. And those are the weeds, right? And he's literally like, okay, you want them a third, because what you don't want is all weeds in your portfolio that are getting ready to turn, or all weeds in new companies where there's nothing working, because you'll get fired, right? And not only that, but you'll have really bad performance over that period of time. And so I look at it that way. I'm like, I don't want all of that. I want a portion of my portfolio there. And they also give you a better chance to buy high and sell low, and do the trimming that we discussed. So that's kind of how I think about it. It's just, I'm trying to to say, okay, I got 20 names. I want certain of them to be compounders, and I got those. And I want certain the ones to be turnarounds, and I want certain one of them to be, more cyclical. Hey, just things are just out of favor right now. I don't own an office REIT in the portfolio, but with all the carnage there, I'm looking. That's something where you say, okay, well, people come back to the office in 4 or 5 years. I don't know yet. I'm not comfortable enough, but it's worth to go look. Similarly, when oil's, $40-$50, and you can see the economy starting to come back and we have a vaccine, we went pedal to the metal, that November of 2020, because we're like, oh goodness, if this comes back, these things are going to do really well, because they're pricing in, $50 oil forever, which doesn't make sense to us. So, but I'm willing to wait 2 years to get those. Now, it didn't take 2 years. It took a year for those to really get going, but that's what we're trying to do. We're trying to stack the portfolio with different exposures, different things happening. And that comes back to being able to do that within a concentrated portfolio. I think it helps it, right? And everything is about risk and lowering your risk and not losing money. And so those are the things we've done to the portfolio and how we think about it to reduce risk outside of saying, hey, volatility is risk. So it's really a comprehensive way to manage the portfolio.
And within those buckets of companies that aren't necessarily compounders, but maybe are trading at good recent valuations, how have you thought about trying to avoid investing in value traps, which is a security that it always looks cheap, even it's cheap at 100, it's cheap at 50, it's cheap at 25, and it's cheap at 5, because the results deteriorate even fast, as fast as the multiple. How have you thought about mitigating that risk?
I've done that. Obviously, I've done that. Every value investor has done that. I would have done Generac earlier and lost 40%, but I didn't. And I did it with Altice. So I own this company called Altice. It's a cable company, and it had fallen quite a bit, and it looked overdone to me, and it looked like they still had their cash flows left, and it looked like their explanation for their short-term issues seemed completely rational to me. And not only that, but they were, I thought they were making a good decision to invest to expand their fiber, and they were investing appropriate amount of money. They had a lot of debt on the balance sheet, but I'm like, okay, it's cable, it's subs, and I went and tried to catch that falling knife, and it hurt. And from that, I was like, there's got to be more ways to think about this. And one of the things that I've evolved as an investor is, which is unique for value investing, is one of the things I do now is I look at we actually look at when it comes time to make that buy decision, or like, okay, let's go in. I'm looking at the technicals now. So I'm starting to say, okay, has this stock at least shown some kind of bottom pattern? Is it coming back above its moving averages? And that's actually helped us, because it made us sit on our hands for Generac while it went from 200 to 100. Similarly, same thing with Expedia. We sat there and we waited, and when we want to add a new name to the portfolio, we have 3 or 4 names that we're ready to go on. And the other thing we're doing is we're watching to say, hey, are one of these starting to break out? Or one of these starting to work? Because a lot of time when you're doing that time arbitrage play, or you're waiting, it can be 2-3 years, or you can be wrong and it's going straight down. So Altice was going straight down when we bought it. And I can tell you that's probably the last time I'm going to do that. And by not doing that, I think it's helped us. And it's something that's new that we've been doing for the last, really 2 years since that happened. And I think it's benefited us in the new names that we bought. So we've sat there and waited. And for example, when it came time to add to the portfolio, and we saw, we had their 3 names, well, Expedia started working. I'm like all 3, Expedia we thought fit in the portfolio well. And so we pulled the trigger on that one. Now the other 2 have done well too. So, if we just waited a few months, it would have been fine. But I think it has really helped us as, trying to avoid the value trap. And being patient and not saying, okay, hey, look at this stock is trading this big discount, like to our estimate of intrinsic value, to our range of intrinsic value. Let's just go now. It doesn't matter, But the reality is there's been too many situations in my career at Artisan and here where you've done that, and you're not going to catch the bottom. I can't time the market. I don't think anyone can. And you can't time even an individual stock. But I think there's enough people out there that are doing quant analysis and all the computers now that when, you see, okay, hey, the 50-day moving average has moved up. Hey, volume's moving up. Hey, we're just crossing the 200-day or we're crossing the 160-day. And not only that, but like, you're starting to see, that with volume, okay, hey, yeah, I might have missed the very bottom by 10, 15%, but if it's still trading for 40% on the below my, low end of intrinsic value, I should pull that trigger all day. So that's just something we've kind of added. I think it's unique for value investors. I'm not like, I don't think anyone else I know that does it. And it's something we've added in the last 2 years just on that, the final, okay, let's go decision on buying a new stock. So sometimes, for example, if I don't have any stocks that are doing that, I'll wait with 5% cash or 6 or 7% cash in those positions, waiting to find one of the ones that are on our watch list. And so, what we do here is we watch a lot of companies. So we're watching 170, 180 companies. We learn a new one. We spend a lot of time putting that on there, and that's really been developed over my experience at Artisan as a generalist. So one of the reasons I went to Artisan to begin with was it was very hard to find a generalist role in investing, that they just don't exist. And I remember I was sitting in an interview when I was at Wharton with the people from Fidelity. I'm like, I'm really sorry, do you have any kind of generalist roles? And the lady lit up and she's like, we do have a generalist position. And the way it works is it's this rotational program. And like, you could be covering Nordic Airlines for 6 months, and you can come back to the United States and cover something else for 6 months. And I was kind of like, no, I want to do the Nordic airline in the morning and the utility in the afternoon and the semiconductor stock, next week. And Artisan afforded me that ability to do that. So when I was recruiting, I was looking for value shops with good investors who could mentor me. And I was looking for places where I could be a generalist so that I would have this capacity to go do that once I decided to start my own place and be a portfolio manager myself. I just think coming from one industry and then becoming a portfolio manager has got to be really tough, because then you got to learn all the other industries. Let's just say I had 6 analysts running around and I was just an energy analyst and I became a portfolio manager. Well, I got to sit there and really trust the person who knows Expedia really well to be able to get comfortable with it. One of the things about being a generalist is, am I a super expert on everything? Absolutely not. Do I know enough to be dangerous? Yes. And I know enough that, okay, I put guardrails in place. These are the companies I know. I think these are great companies. I would love to own them at the right price. And we keep finding them and we put them on the board. So we got a screen on Bloomberg. It says, hey, these are the companies. I put them up there. They're grouped by industry, and we're watching them all the time. And when something happens to them, like a CVS gets in trouble, recently, like, hey, we can go pretty quick and do our work on CVS and see what's going on. Disney's starting to get in trouble. We can do our work on it. I think there's still room for it to go down, so I'm not going to do anything there yet. But we can move a lot quicker because we already know the companies, and it just allows us to move quicker and make those decisions, and it keeps us out of trouble. But starting from that point, we watch those, and then if something is getting close, is starting to trade below our intrinsic value, things are happening, we move those to a different part of the screen and we start watching those more closely. So like right now on that list, we've got 8 companies on that list. Like I said, 3 of which if you said, hey, Tyler, I've got to replace Capri today because the deal's going to fall apart, something's going to happen, like I would get, we could pull one of those in if we needed to quickly.
And I noted that you'd created that 170 company watch list, and I thought that was fascinating. Can you talk about the criteria you use to compile that watch list? Like, what does it take to get on that list and stay on that list?
Well, the first thing is, have you shown that you have a business that has some kind of competitive advantage with sustainable margins? We start there. So that's number one, because if you don't have, it doesn't matter who's managing the business, how they're allocating capital. If you do not have a good business, that's table stakes, right? So we spend a lot of time looking for those, and there's evidence of that, right? You see high margins, high returns on invested capital. You generally see companies that throw out a lot of cash. They're making smart investments. Like, those are the first things that we look at, and we do a full analysis of the industry. So when I started as an analyst, it wasn't like, hey, go find random stocks. It was, here's the utilities, go learn the entire thing and find the best ones. Here's trucking companies, go learn the best ones, find the best ones. Here's semiconductor companies, same thing. So when I started at Artisan, it was go do a whole industry deep dive, find the best performers in the group. And then that's how they got on the watch list to begin with. So the watch list was originally created by saying, hey, these companies we did the whole industry. These companies look great. We're going to start watching these ones. And so a lot of the list came that way. Since then, you're picking up new companies that either, for some reason that something's turned around there or something's happened, or, hey, I might have missed this one, or I just didn't know. Like right now, I'm doing a deep dive on Restoration Hardware. I've never really looked at it before, but there's something special happening with that CEO and the margins look great. And I got to go figure it out. So for example, that might take me a month to learn, but if it's going to get on the list, it's going to get on the list, right? If not, hey, fun, it's still there. I'm aware of it. I know it now. But am I going to keep following it? It's if I think it has those characteristics. And the other thing besides just, are you a high quality company that can continue growing and protect your margins, is, are you shareholder friendly? And there's a lot of ways we think about that. And quite simply, one of the first things you do when you look at a company is you pull up the proxy statement, you look at the pay section and be like, is this reasonable? And then you look at related party transactions. Because if this CEO is not going to be if he's going to, I don't want to use the wrong word, but if he's going to be less friendly to his shareholders, well, I can guarantee right now, if his son or daughter is working at the company in HR and they're making $600,000, $700,000 and getting stock options, this is probably not the person you want running your business. This is not a shareholder friendly person. And so we think about those things. We look at how do they allocate capital. One of the things I like to do when we add a name to this list is I'll pull 10 years of shareholder letters, and are they telling the story, over 10 years, right? Is the CEO saying, hey, we're going to do these and these things are happening? You can see it over a long period of time. I always used to appreciate, there was this, the CEO of, it used to be Agrium, now it's Nutrient. And now he's since gone over to Corteva, but he would write this great letter every year, and he'd say, hey, here's the things we're going to do this year. And then, oh, by the way, here's what I said last year, and here's how we did against them. I mean, I wish every CEO would do it. It would make life a lot easier, right? And you can see, hey, these are the goals. These make sense. And a lot of times you see operating margins increasing at a company. Well, if you go back and look at the letters, you can see, hey, 3 years ago, they said, we're going to try to improve operating margins. It's going to be through X, Y, and Z. And then you go look and they actually did X, Y, and Z, and now operating margins are higher. That gives me a whole lot more confidence in the management team and their ability for those margins to be sustainable. So those are the kind of things we're looking at. And just, hey, if you made acquisitions or stock buybacks, I want to know why. Like, are you just buying stock to offset dilution? Because in my mind, those are two different decisions. You shouldn't ever. If I ever hear that, like, I'm just not in. We're done. I'm not interested. And the difficulty is there's not a lot of great capital allocators out there. Buffett's obviously an easy one. So owning Berkshire, I don't have to think about that. But if you look at the book of The Outsiders, there's not a lot of companies in there. So finding those CEOs that can manage and allocate capital, that aren't just blindly wasting money. When you find all those things and put them together, I think you're going to win over time. And we consider those our guardrails. And if you combine that with a great balance sheet, where they can't get in trouble, I think you're reducing your risk. And if you combine that with, oh, by the way, they're giving you all the cash back and a great dividend yield, that's just one more. That's one more piece of money they can't waste. It's one more confirmation that the earnings they're making are real and not accounting gimmicks. And it's, allowing me to reallocate that to a higher use. Because by getting that dividend, they're telling you, if you have a company with a return on invested capital of 15% and they're giving you a dividend yield, it means there's not a lot of opportunities left for that 15%. And, I appreciate that. And, we can hopefully compound double digits. That's our goal. So, I'm happy to take that cash and go do that. But yeah, those are the things we look for. We create the guardrails, keeps us out of trouble. And that's the process to getting on that board. And then we watch you, and we do an intrinsic value range, and there's a low end and a high end, right? We try to get some kind of normal earnings power of the company. What should these guys look like in 3-4 years as normal events occur? Just so we know what are the outliers, what something bad happens, how do they do in 2020? How do they do in 2008? And we come with that range. And then once it trades below it, or it gets close to it, it goes to the front of that watch list, like I described. And then from there, it can get into the portfolio or not. And we have had a few opportunities where we've owned the company twice because they've gone to the top and come right back after we've sold it. So CVS was an example of that. We bought it at $70, sold it at 105, and now it's back to $70. And like, we looked at the math, and in fact, the earnings power went up, our estimate of normal earnings, and we don't think the valuation multiple changed. And so now, we're back in that stock.
And you mentioned dividends, and I think given the popularity of growth stocks recently, these companies often don't pay dividends, and so dividends have maybe taken a back seat in recent years. What do you think people are missing if they're not focusing on yields that you can get from dividends when you look at the total return profile of a company and a portfolio?
Well, I would say first of all, you don't need them. It's not a requirement for stock to have a dividend to get in our portfolio. I mean, we own plenty of companies that don't pay dividends, but they're compounding at higher rates and they're reinvesting the capital. Like I said, Berkshire doesn't pay a dividend, but we own it. For me, the dividend is just a reflection of the cash flow, and it's telling you, hey, we have a very strong business and we feel confident giving you the money back. And we do have two stocks in the portfolio that they have very high dividend yields that that are out of favor right now. We own Verizon. Verizon's probably been the weakest performer we've had outside of Altice during our 5-year run here. And when I look at that right now today, you're getting like an 8% yield. So if you think about it, to lose money on Verizon here, even I think their earnings power can actually increase as they reduce their spend. So right now they're spending 22 billion a year on capex on 5G. As that rolls down to $17 billion, you're going to have a little bit extra money. They're going to be able to push some more pricing power at some point. Their subsidies for iPhones will come down probably after this 15. T-Mobile is a little bit less aggressive than they used to be. AT&T has no room to be aggressive. So you're looking at this and you're like, okay, I think they can make $5 a share, even if they just do it for 4 or 5 years. I think they can actually increase that in the outer years. And you look at that and say, okay, well, it's getting an 8% yield. So that means in order to lose money from here, the stock has to go down by 24%. If it goes down by 24%, it's going to be trading for about 5.5 times that earnings number. And you got to sit there and go, should Verizon trade at 5.5 times earnings? And the answer is probably not. Right now, so when you look at that dividend, it gives us a lot of room to be wrong. It almost creates its own margin of safety, if you will, if you believe in the strength of the dividend and being there. Altria is the same way. We own Altria. Same thing, 8% yield, a really high yield, and they're actually growing earnings every year. So they're not even in the situation that Verizon is, where they're not. And then once again, they're trading at a low multiple. It's interesting. Jeremy Siegel was one of my professors at Wharton, and he brought up when we were there, he's like the best performing stock over the last 50 years when I took his class back in 2008 was actually Altria. And, no one guessed it in the room. Altria crushed everything. And you're like, well, how is that possible? They had all that litigation. Everyone knows smoking is bad. Everyone knows, cigarette volumes have been going down for 30 years straight. Like, how is that possible? Well, what happened is they gave you all the cash back and you could reinvest it at 10 times earnings over a 50-year period. It just crushed everything. There is, not to come back to the word compounding again, but, you can reinvest the dividend, a high dividend, you're doing pretty well. It really gives you a huge advantage to compound quicker. And that's effectively what we're doing with those two names. The other name with a high dividend yield that's in the portfolio, the energy companies do, but that's just variable dividends that they're paying now. But we also own Artisan Partners. And I know I worked there in the past. So people are like, hey, why do you own that? I didn't think I would own it. It's one of those things that kept showing up on my screen. And you can say, I obviously know the business really well. And I had never been a shareholder in it before. And we bought it. I was looking at the stock price. And I'm like, okay, well, the stock is reflecting an AUM, in my mind, somewhere around $110 to $120 billion at Artisan. At the time, they had about 150. Right now, they have, I think in the last month they released, it was 142 billion. So that stock in my mind is still incredibly undervalued at its current price. Because it's reflecting a much lower AUM level. And even if you say, okay, hey, look at them, it's looking ahead and seeing some kind of big 20% sell-off coming, well, that's fine, because then I'm paying that price today, right? So I'm getting that value today, and they give you all the cash back. So they have a variable dividend model. CME Group, which we own, has the exact same model. And I wish more companies would do this. So what they do is they pay a low or moderate, hey, we know we can make this every year. Here's the quarterly dividend. And then they pay a variable dividend on top of it. They pay it out every quarter. So whatever excess cash flow they have left on the balance sheet that quarter, they give it to you. CME Group does a similar thing where they pay it off at the end of the year. They say, hey, look, and they do something even better in my mind. I think they have the best dividend policy out there, the best capital return policy out there. So what they do is they give you the small little dividend every quarter. And at the end of the year, they give you a special dividend or they'll buy back shares. So they literally tell you, hey, we need this much cash on the balance sheet. If we end the year, whatever is above that, we're going to pay you back. And not only that, but if our stock is really, really cheap, we're going to signal that to you and we're going to buy back the shares. So it almost has this mechanism built in where they're not going to do share repurchases unless it's really, really cheap. I think a lot of capital is wasted with that. I had some healthy debates with my former professor Alex Edmond. He's at London Business School now, and he's a big fan of the buybacks. And I think it destroys a lot of value. And the reason buybacks destroy value is, well, when do you have excess cash? Well, when things are going well. Well, when things are going well, what's your stock price? It's likely fairly valued, or most likely, even more likely, overvalued. So you're destroying value by buying back shares, in my mind. And you're seeing a lot of that out there right now. You've seen a lot the last few years. I know a lot of people regret doing buybacks, in 2021, where then they got, oh my God, I could have bought it so much cheaper. So, and even Restoration Hardware. So they just announced on their quarterly call a week or two ago that they bought back 17% of the shares because they just thought the stock was undervalued. And I'm not sure what the valuation is yet because I'm still working on that. But I saw that. I'm like, wow, that's a message. So if he's right, he just created a ton of value. But if he's wrong, he just destroyed a ton of value. I'm still working on that. But when you see that, I think it's telling you something too. Like, okay, this person understands capital allocation if he's right. But what you don't want to see is at the top, like, that stock I think got up to as high as $600 or $700. It's nice to see that he did it at 350 or 325 and not 700. So if he came in at 700, it's like, hey, I'm buying back 17% of the company because we have the cash. That would have been very destructive.
And you mentioned that you own Artisan. I think some people might say that it'd be very hard for you to disentangle your own potential biases given the duration of your experience there. How do you separate yourself from your experiences there? The people how well you know the business. Obviously, familiarity breeds liking. I mean, talk to me a little bit about how you thought about risk managing your own biases in the Artisan position.
Yeah, I think when I look at Artisan in my, I wasn't a shareholder prior to it, so they never gave me shares when I worked there. Artisan too is a little bit different where I didn't know all the other investment managers. So they silo things off. So it's not like you're sitting at a floor in Boston if you're at Fidelity or you're in Baltimore at T. Rowe and you have all the teams that are there. So the way Artisan works is they actually silo the portfolio teams. So for example, the US domestic value team, which is what I worked out, was in Atlanta. The domestic growth team, they're up in Milwaukee. International growth teams out in San Francisco. The international value guys are in both San Francisco and Chicago. They have this great manager who does high yield bonds. He's out in Kansas City. So you don't really, you don't build that like you would think, right? So a lot of stuff happens within the silo. And when I look at Artisan, it's like a boutique. It's like a very well run boutique, but they have separate boutiques. So it's almost it's not the same. It's not similar to the traditional asset manager out there. And I think that's part of their strength too. So, it allows them to go get the best people. They say, hey, we think you're really good at what you do. So when they brought Brian Krug in, for example, to do the high yield, they're like, hey, you can live wherever you want. You get the resources you want. We just want you focused on investing. We're going to bring you world-class distribution. And that allows them to attract better managers, which has produced really good returns. So you look at the Morningstar Awards, like those people have stacked them up over there. The guys I worked with got a Morningstar of the Year. The growth guys have got Morningstar of the Year. The international guys have all got Morningstar of the Year awards. So they've been able to attract really good talent. And as long as those people are there, I think that's key. Now, if I sat there and I saw, hey, if Samra and O'Keefe on the global teams left, yeah, you can, and there's, they have like 50 billion between them or 40 billion between them. That's a problem. That's the biggest risk with owning Artisan in my mind. And they have a lot of new guys that are starting to prove their worth. And I think Artisan is also unique is their distribution. And you can see this in the AUM, right? Because there's been outflows from active for a very long time now. It's even the team that I was on at Artisan, like those have stopped. They have built a very good distribution arm. They have a very good business with the pension funds. They have very good business with all the 401k programs. They have great business with, sovereign wealth funds. And because of that distribution arm they built and because of the talent they've been able to acquire, I just think that their earnings have been a lot more stable than you would have expected. And you can see that in the numbers. And am I biased? I'm sure everyone's biased. I don't think I'm biased in putting that in the portfolio, because when I did it, I look at things and say, okay, our portfolio, what's the operating margin of all the companies? What's the return on capital of all the companies? What's the leverage, so the net debt to EBITDA of all the companies? What's the dividend yield? And then what's the PE, and how does this compare to the market? When I look at Artisan on all of those metrics, it's a screaming buy in the portfolio, right? So it's trading for 10 times earnings. The market, even the value index is, it's 16 times right now. It's got no debt. It's got, operating margins are anywhere between normalized between 35 and 44%. They have amazing return on invested capital. So when you look at that compared to all the stuff I have in the portfolio, it actually meets it better. Asset management is a great business. The key to it is finding an asset manager that won't collapse and go away really quickly. And there's a bunch of them that will, like T. Rowe, awesome distribution model. Fidelity, if it was public, I think would command a very high multiple. Artisan is one of the few ones out there too that has been able to build the distribution, been able to get good numbers. That's why I feel comfortable doing it. Now, it's also the smallest company in the portfolio. And as we've, the last 2 or 3 years, as assets have come in and I want more liquidity, we've gotten rid of some of the smaller ones, like the Atlanta Braves, for example. We own Liberty Braves. We got to the point where that got to the high end of fair value, and liquidity was really not there. So it's like, hey, we had this, we had to get rid of that slowly. And Artisan, when I look at the portfolio, the 20, it does have the least liquidity. So if there was, hey, if we could continue to get bigger, Artisan's going to be gone just because of the fact of I don't have enough liquidity that I feel comfortable with. You don't want to go to the market on a really bad down day to have to sell something and it's not there. I don't think that's going to happen with a Google or, any company over 10 billion. You're not going to see that. With an Artisan, you definitely could see that with the Braves. So that is another, come back to the whole risk management, which is a central theme of how we think about a concentrated portfolio. Is I don't want a lot of those, and Artisan, if Artisan went up to 100, $160, $170, it would be gone. And we'd be like, hey, that was a fun experience. We made a lot of money and we got a huge dividend along the way. Similarly, if something comes along and it has similar criteria and it's, uncorrelated with the rest of the portfolio, kind of like Artisan, and I would get rid of it. I would upgrade. It would be on the upgrade list.
Got it. And I want to take a step back from the portfolio management side, because we've talked a lot about ideas and specifically your strategy. And I think I think it's been really helpful for people to understand. You personally decided to write a book called The Value Investing and Discipline Framework that was published in 2020. I'm interested in what the spark was to sit down and write your own book.
Yeah, it's a good question. Thank you. It was published in 2020. It was written in 2008. So I was actually at Wharton, and I had a let's just say we had some extra time because recruiting was really tough, trying to get a job in investment management. And I thought that, hey, what if I, put my thoughts down in paper, and I was, I needed ideas anyway. What if we said, hey, here's how I think about investing, and here's some examples of some stocks that we like, trying to use this methodology, and put it all together. And it was really a paper, right? It was this large paper. And one of the things I like to do is mentor young potential analysts. I do a lot of internships where I, try to get kids in their between sophomore and junior year, and I'm teaching them, hey, here's how you do a stock write-up. Here's how you go look for a job. You can put your name on my resume. You can put my firm on your resume. Really, it's more of a mentorship program. And it's like, this is how you think about it. And I would give them this manuscript. And then one of my interns in 2020 took it and just loaded it into Amazon and came back to me. He's like, hey, by the way, if you want to press go, I converted it to a book. It's ready to go on Amazon. Is that okay? They made the cover art and everything. And they just apparently it's super easy to do. And I'm like, hey, let's go for it. And so, he showed me that, and I was like, okay, I pressed the button, and now every month a check for $2 to $10 comes in the door. So you're not going to get rich, but it's that's how that happened. And it's kind of interesting looking back at it now. In fact, this new analyst I'm training, I gave it to her to read, and you can see there's still even errors in it when I wrote it. So at some point, if I ever find free time, I should go back and correct some things and fix some things, because my views have changed, obviously, as we discussed it. So, I didn't know what I didn't know back then. And, it's also interesting looking at the picks, right? Because you get the normal dispersion you would get from an unexperienced investor when I wrote those. You've got one name, Rockwell Automation, who went through the roof, went up 10x. Microsoft went up 10x. Diamond Offshore went to 0. And Carpenter Technologies kind of went sideways. A cyclical company up and down. So I guess you could have traded it well, but you wouldn't have gotten rich. Microsoft at 16 solves a lot of sins. And similarly, Rockwell, I think, was 25 when we wrote that in there. So the fun thing too is you can go back in 08 and be like, hey, Tyler picked these stocks in 2008. What happened? So it's a fun time capsule at the same time.
This season of Compounders is sponsored by Dalupa. Dalupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dalupa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dalupa.com/compounders. And you mentioned that you're training an analyst and you're building the team. I have some experience being at kind of a resource-constrained shop where I was kind of covering an entire universe by myself. So I'm interested in your strategy for trying to balance new idea generation and looking at companies that are on the list but not in the portfolio versus the maintenance research that you have to do on the existing 20 stocks.
Well, when I think about so a lot of the inflow that comes where you're doing maintenance issues, luckily it comes in a month and a half period, right? So a lot of the new name search happens I like to say the third month of every quarter, right? So for example, right now, there's no one's reporting earnings. The conferences are going on and those are easy to keep on top of, but really not a lot's happening, right? And so, unless you have some news item like today, like we own CBOE and the CEO had to abruptly exit. So we have to go, figure out who's replacing them. But there's not a lot going on, and so the last month of a quarter gives you a lot of opportunity to go do that. And so what ultimately happens is if you come to my office, there's a stack of paper, and it's like, hey, here's new things that I don't know and we start going through them. And if we find something we like, that's when we really get into the deep dive. We're doing the Ks, doing all the quarterly conference calls going back years, talking to anyone who I know on the ownership list. That's a great resource. A lot of times too, you might pick up something on a podcast. You're like, wow, I'm not afraid to steal an idea, and this seems like a great idea. And I listen to your podcast, listen to some of the other great ones out there, and like, what, I'm going to put this on the list to go look at. And the only difficulty with that is sometimes you put something on that list, and the loss goes on for a month and a half, and you can finally get to it, and you're like, oh, I wish I did that because it's up, 30-40%. That happens. Doesn't happen a lot, but at the same time as I don't have to swing at every pitch, and there will always be something else out there.
Yeah, you're always going to miss things. It's part of the business, and you have to kind of get comfortable with that. And from a business perspective, you're building this thing. You started in 2018. You now have a great partner in Moran. What do you think success would look like if we're having the same conversation 7 years from now?
I think success is all about, in my mind, hey, did you continue to beat the market? Have you been able to do it with bigger size? Have you grown your AUM, have you continuously grown your AUM and grown the business? And have you delivered for shareholders? And I think at the end of the day, that's all that's how I would measure the success or not. At the end of the day, I'm like any other kind of value investors. Like I just want to put up a really, really high number. And if AUM didn't grow from here, it would grow from the number by itself. And that would be fine too. It'd be great if new money came in. It would be great to manage money for, bigger institutions, pension funds, because at the end of the day, that's just more people that you get the ability to, I think about it like I'm looking after their nest egg, right? So the more people that I think I'm looking after their nest egg, and if I'm putting up good numbers, that's success. And the beautiful part about doing it in Moran is, they have the resources to then go and to then grow it, right? And with the size of market cap that we're doing, I don't see how there would be any change in how we manage the portfolio if we had 5 or 10 billion under management relative to what we have today. So, and I saw that at Artisan, right? So at our large cap portfolio at Artisan, we could you were trading things in seconds. Once our mid cap portfolio at one point was about 16 billion, and that took a while. And you get a new position that might take a month. Small cap, At one point, it was 4 billion, and we had 90 or 100 names in that portfolio. I can't remember precisely, but you would get a new position and it would take 3 months. As long as we're not to the position where our size is constraining how we can make money, then size doesn't matter. The day that happens, that's where you slow down. And this really comes back to focusing on what I talked about, which is the record. And the end of the day, like, can I compound money at a very attractive rate? And if I can beat the market, that's great too. And, that's our goal. And, double digit returns are our goal. And that's the scorecard that we measure ourselves against. We measure it over a 3, 4, 5 year period. We don't think about it day to day. I know a lot of portfolio managers that watch the portfolio day to day, what's happening. I really try not to. I can see it on the Bloomberg screen, but I don't add it up. Right. So I can look at it and go, oh, hey, I got, 12 names up today, 3 are kind of flattish, and the others, 5 or 6 are down. And I know I'm winning that day, but I'm not like watching, oh, hey, we're up 50 basis points versus the index. I just don't care. I care at the end of the year. I care, at the end of 2, 3 years. With the big drawdown we had in Q1 of 2020, climbing out of that hole was a big goal. And, we're back ahead of the indexes again, and that's great. And we've done really well the last several years. So that's kind of the benchmark that I think about that success is. And the more people that can ride along on that success, the better.
And when you had that drawdown in 2020, you guys had, as you said, you were 17 out of 20 companies were uniquely exposed to COVID. I know it's not a lot of solace, but like there was no way for you to predict this was going to happen, right? Like COVID was kind of a off spreadsheet event. But what do you think you learned about yourself as a decision maker during that very tough period?
I learned that, sometimes as an investor, you worry that you get married to your names, and having that happen, and then still being able to go and be, okay, we're like, I love these companies, or I know they'll bounce back, but I'm going to sell them something better right now. Knowing that, hey, this is a big hole and it's going to take you 2, 3 years to get out of, and you're by yourself. Can you go do that? I think it was more a test of, hey, can you do this? Can you recover from this? How are you going to do it with this psychologically because you're by yourself? How are you going to do you have the wherewithal to make it back with something else? A lot of times Buffett talks about it. You do not have to make it back the same way you lost it. And I think a lot of investors, they want to wait till it gets back to even. And if I had done that, I think it would have worked out over time. I know we looked at it, but I'm glad that I, under fire, had the ability to keep a clear mind and go find better things and take advantage of the opportunities, like Amazon at $2,800, pre-split, and some of those great companies that you could go buy for nothing, Republic Services. So the thing I think I learned most was I can't, I'm never going to go through another one of those without a partner. Mm-hmm. Being by myself was really difficult, and it was tough. It was like drinking from a fire hose. I mean, when I think about that time period from, call it March 7th, when I realized we have a real problem, till maybe end of April, to me, that felt like 3 years. It just felt like nonstop. I got up at 6 o'clock and worked till 11. Like, I didn't see a lot of my family. I think looking back at that, and it just really made it clear to me that the error of not bringing a partner with me when I started the firm, and not bringing a salesperson, and not bringing someone else I could really talk to. I had mentors and, former portfolio managers who would, they'd give me a call and cheer me up when we talk about stuff. But I really did miss that. And, one of the benefits of being here at Moran is that's not going to be an issue again. So there's, people, I got some really good investors here that I can go down the hall and talk to. Yeah, I don't have to worry about the business side of it either. I can just focus on the investing. So I would like to think if something like that happened again, that we would perform even better than we did last time. And then last year, we did do that. We saw the big sell-off in the market, and we did just fine. So it's been a trying 5 years if you think about it. I mean, if you told me to get into 2018 that, hey, you're gonna leave Artisan, we're gonna have 3 bear markets, two really huge rallies, a pandemic, and probably one of the biggest bubbles of all time in the next 5 years, I would have said no way. But here we are, and it's happened. So, it's interesting. I had a call the other day with a pension fund, and at the end, he's like, we really don't want you to have 10 years of investing experience. And I was like, you know what? If we were having this call in 2018 or 2019, I would agree with you. We've had a market that's gone straight up. We haven't seen a bear market since 2008. We haven't really had an investing cycle. I mean, it's been a 10-year investing cycle, so you're absolutely right. But in the last 5 years, we've had 3 cycles and we've had 3 bear markets. And so I would just wholeheartedly disagree with that statement anymore. I'm glad that I was tested by it, but at the same time, I wish I had a partner going through it.
Yeah, no, that's really good advice for anyone who's thinking about starting their own firm. So Tyler, we've talked about a lot. We've talked about portfolio construction. We've talked about a lot of ideas. We've talked about your evolution as an investor and as a business person. We're going to close this podcast with the question we ask all of our manager guests. What is the most underappreciated aspect of the investing opportunity set that you're pursuing at Seagate?
I think in the end of the day, looking at a portfolio and knowing that we have better companies measured by return on invested capital, measured by operating margins, measured by higher dividend yields, with less leverage, and that are trading for cheaper prices in the market. If I can have a portfolio that has significant gaps in all 3, we're going to win. And you're putting everything in your favor. And there's no reason that those companies, A, shouldn't trade more than the market. And so when you have those companies and you can buy them at a discount, you're going to win. And not only that, but when you have down markets, you're going to have less downside. And particularly we saw that a lot in 21, or 22 rather. So, I think that's probably what really differentiates us. I think just from a value perspective, I think thinking about when we go do the purchase, when we make the purchase decision, actually adding a little bit of quantitative analysis to it or technical analysis to it, I think that's unique relative to other value investors. And I think the concentration is unique relative to other people too. Not a lot of people concentrate. I think there's way less risk to it than is out there. And I think the data shows that. I think the performance has shown that. And I think those are the unique differentiating factors of Seagate.
Well, Tyler, congratulations on the first 5 years. As you said, you've been through 3 cycles already. Probably, just like myself, and have developed some new gray hair because of that fun experience going through 2020. But I think you've positioned yourself, from a performance and a kind of like process perspective, be successful. So thanks again for being on Compounders. It was really great to hear your story.
Thank you, Ben.
During this podcast, Tyler discussed a number of securities. The only securities I own are Berkshire Hathaway and Generac.